Well, for a client with a will that is drafted in what we think of as the conventional way, so a married couple where you've got husband and wife leaving everything to each other, someone with an estate of that size would lose one of their important nil rate bands called the residence nil rate band. So really, the first 650,000 would be tax free. Everything above that is usually taxed at 40%, although there might be exempt gifts or charitable gifts, for example. So really, unless they've made any gifts in the previous 7 years, the tax bill will be 40% of the excess for a married couple over 650,000. But that actually introduces quite an interesting quick win that we look at when we've got a client, married couple, with an estate of £4 million or less. And the reason for this is the fact of losing both nil rate bands on second death is because the estate is over the rate at which it is fully tapered away. But if you think, for a client with less than 4 million, a married couple actually separately to each other could have an estate of £2 million. So with a bit of planning, it doesn't take a lot to introduce a clause to the will that says, if I die first, and if my estate is £2 million or less, I'm going to use the residence nil rate band on first death. And if we work it through, there's a bit of an example on the website, but that's a pretty quick way of making one very small change to the will to save £70,000. I mean, there's all sorts of different allowances, and I think the first thing that a married couple needs to do is to ensure they're both on the same page as each other. Because when we talk about using allowances, what we're really talking about is typically either giving money away or investing in something that carries an inheritance tax relief. So you've got the small allowances that everyone gets. You can give away £3,000 a year. And if you do, it's not subject to the 7-year rule. So that if you die within 7 years, it doesn't come back into your estate. You've got the small gifts exemption, which is £250. Different exemptions when your child or grandchild is getting married. But ultimately, both clients need to agree that they're comfortable doing things and taking actions that make their children better off. But also what that typically means is they're doing things that is making their estate smaller in order to make the tax liability less. So the first thing that the husband and wife would need to do to ensure that their allowances get used, whether that's the little allowances or, the nil rate band of 325,000, which is the most you can give to a trust, is to ensure that they're both on the same page and that they're comfortable taking actions to reduce the size of their estate to provide a much bigger increase to the well-being of their children and future generations. I think when we're looking at planning, the first thing that we start to do is we look at what is the situation now. And for clients that are in a position where they're comfortable that they have enough money for the rest of their life, the issue isn't so much about how do we stop there being too much inheritance tax on what we have now. It could be that actually if you're looking at planning and you're in your mid-60s, your 70s, or even towards the end of your 70s, but you're in good health, the growth that you can see on the assets that you have, whether that's from the point of view of your house, if you've got an investment portfolio or a SIP that you're not spending, any assets that are growing over the course of your retirement and that are not being used, the growth on the value of those assets is likely to be substantial and actually continue to increase your inheritance tax bill. So one aspect is to try and reduce the tax that is due if you die now, but another thing which can be as important or more important is to come up with a strategy to say, how do we prevent this tax liability growing exponentially? Because as we all know, the government really is quite reluctant to increase the tax allowances and the nil rate bands that we have. It's important in the sense that, a lot of the time a decision will need to be survived by a period of time in order to have success. So, some investments carry tax relief after 2 years, some gifts or gifts into trust or various different other strategies can be successful after 7 years. Other investments or other tactics can take effect immediately. So if we know that there is a time-critical decision, clearly we'll know what the rules that will have to be met in order for that to be successful will be. But it's all a little bit moot if you don't know actually when you're going to die. So when we're looking at the planning, the question is, do we actually have a problem that we're concerned about enough to take action now to put some plans in place? And knowing that the longer we leave it, A, the less likely it is to be successful, and B, the more our estate is likely to have grown by, and the bigger the problem that has not been addressed is likely to become in the future. The most efficient way is to reduce the value of the estate, and that's either done by spending the money to live the best retirement that you can, or by giving it away. It could be that you give it away to children or to trusts, in which case, there's the 7-year rules that I'm sure you'll be familiar with. Of course, there's charitable giving as well, which is immediately successful. So while, of course, charitable giving does very little to enhance the value that goes to your children or your future generations, from a tax perspective, the most useful, the quickest way of reducing the value of your estate is to make yourself less wealthy or to use charitable giving. Ultimately, when most of our clients are instructing us for planning, it might not necessarily be that their goal is to minimize the tax. What they're really trying to do is to maximize the impact of that money to the people or to the causes that they care most about. Slowly. I think the first thing to do is to understand the extent of the various different criteria that you've got. And so we ask our clients to fill out a questionnaire in advance of the first meeting, which rates the different criteria that we can find pulling in different directions. So as with anything, you can't have an investment that is 10 out of 10 successful in all areas. There's no such thing as one which is high growth but low risk, low cost, easy to understand, tax efficient, ethical. There's no investment that is going to be ticking 10 out of 10 to every box that you could be asking for, because ultimately, if someone tells you that investment exists, what's going to happen is you'll lose all your money because it is a fairy tale. So ultimately, the first thing to do is to understand your criteria, which of the priorities you put the most store in, and which ones you might be prepared to compromise on in order to get benefits in the areas that are most important to you. And again, having a husband and wife with exactly the same opinions in all areas is pretty unusual. So we have the first meeting. It's a bit of an exploration as to, where it is that we're starting from. As the advice process continues, it takes usually somewhere between 4 weeks and 8 weeks to get everyone on the same page, husband and wife, but also to have the advisor understanding you and your criteria and your family well enough that when you're implementing the advice, it's not going to be the perfect solution ever, but it is the most perfect solution for you and for your family's needs. Well, the higher the wealth level, the less important the nil rate band becomes on death. That being said, it starts to feel less like a death time allowance when we're dealing with people that have millions of pounds. And actually, it isn't just limiting how much you pay zero tax on death. The nil rate band becomes a lot more useful in the sense that you're allowed to give up to the nil rate band to a discretionary trust every 7 years. So the wealthier families that I advise are not looking at it as we're going to pay 0% on death on the first 325,000. They're actually looking at it from the point of view of we can make a gift of 325,000, and then if we survive for 7 years, we can do it again, and that's per person. So a married couple could actually do 650,000. Now, if you've got an estate of millions and millions, but you're in your 60s, you'll be looking at this as a function of, well, we might live for another 2, 3, 4 different rounds of 7-year successes. So putting that money into an investment within a trust which grows over time gives us money that can be used to either pay the inheritance tax when we die, or at least to get the money and to get the growth of that money over the long term out of our estate to make our kids better off. Inheritance tax planning will never become urgent for people that are not sufficiently engaged in making their children better off, to make themselves a little bit worse off and to go through some work. And it is sometimes the case that when we engage with someone in the first instance, we'll find initially the idea of paying hundreds of thousands of pounds or millions of pounds in tax on death is something that makes them feel very uncomfortable. But actually, as things progress and the realization dawns on people that you do have to take action, you do have to take professional advice, it is a bit of a process of learning, and it is something where the disadvantages are those that affect you while you're alive, to make your children better off when you die, and to get to the end of the advice process, having explored all the options and looking at the best possible outcome based on the criteria that you thought you had at the start. Some people will look at the disadvantages of implementing any planning and say, no, actually, having explored all my options, I'm not prepared to proceed, and I will just pay whatever the inheritance tax is when I die. And for those people, yes, it might feel a bit of a anticlimax to have gone through an advice process to get no tax saving for their family. And frankly, obviously, that's a bit of a disappointment for our team when people decide that they're just going to have, the big problem that they asked us to fix is going to remain. But even in that scenario, those types of clients that have fully explored their options, at least then have secured the peace of mind that while we might not think paying a huge whack of inheritance tax on death is brilliant, they've now exhausted the planning options that do exist and are properly thought through, so that they can then decide that if the right solution for them is to pay the tax and just, let the children have what's left on death, they never need to think about inheritance tax planning again, which is not the ideal outcome, but for some people it is their ideal outcome. How does inflation gradually increase the inheritance tax? Well, it's not inflation that increases the inheritance tax exposure of a client, it's the increase to the value of their wealth. And of course that is linked to inflation. We know that the value of a house goes up over time. We know that the value of a portfolio will go up over time. And we know that the value of the nil rate bands have sadly not been increased since, I think, about 2008, other than the introduction of the residence nil rate bands. So if you think someone with a more adventurous investment profile, it isn't unusual to see their investment portfolio increase by double every 7 years or so. Obviously, it depends on the prevailing stock market, but that's roughly what you'd expect from an equity-based portfolio. So someone with a £2 million portfolio and 14 years to live could find themselves with an £8 million portfolio if they're not spending it and if they're not giving it away. And of course, that means the inheritance tax liability increases correspondingly. Now, for some people, actually, it is possible to use a little bit of trust planning, which pauses the growth on their investments within their estate. So someone with, let's say, £1 million invested in their own name, which became £2 million over the next 7 years, would find their increase to inheritance tax of £400,000. One of the solutions that clients in that scenario quite like is they can lend their money to a trust. And where we're lending money to a trust, these clients have the ability to get their money back if they need it. But if they don't think they will spend all of that £1 million they've put into the trust as a loan, what can then happen is the growth on the investments within the trust sits outside of their estate. So they still have the ability to use the money they put in, but it pauses that growth within their estate over the long term, which, of course, the earlier you do it, the more impact that can have, because it's the growth over hopefully decades. It's also really useful for those clients that are sufficiently liquid that they are limited in how much they can give to a trust by £650,000 being the joint nil rate band. So again, another example where we've got a very liquid family with a portfolio of millions of pounds, where they want to put money into a trust as a gift, and they are limited to giving £325,000 per donor without paying an upfront tax charge. There is a fairly elegant combination of solutions where you're putting in that amount as a gift, but an additional amount as a loan, which can then be looked at again 7 years later after the original gift has been successful. Mitigating inheritance tax, I would say, is often done by using financial products to reduce the tax that is payable. So there are some tax reliefs that, for example, if you buy AIM shares or if you have an investment in a company which would qualify for business relief on the first 2.5 million, you can buy investments that give you a discount to your inheritance tax rather than wiping it out entirely. There's also the idea of putting money into charitable bequests where you can have a reduction to the rate of inheritance tax from 40 to 36%. You could also find solutions come in the flavour of insurance. If you've got a whole of life insurance where you're paying a regular monthly or annual amount into a trust, effectively the tax still has to be paid because the sum assured from the insurance company is something that you have paid for by way of the annual premiums. Whereas eliminating tax tends to be done using the more established strategies like spending or gifting using trusts or gifting using your exemptions. So any strategy that you devise needs to be able to be adapted depending on the fact that we know things are going to change over time. And it's often interesting to see that the ability of people to make plans that are robust really, really deteriorates during periods of uncertainty. And annually, it happens typically before the budget. But ultimately, if we think the fact that changes could happen is a sufficient reason to not make a plan, then we'll never make a plan ever. So what we need to do first of all is make the most robust and the most personalized plan possible, but continue to review it with our clients, but also have the clients review it with the next generation. Because it's all well and good putting in place a plan with the senior generation of the family, but we know that at some point we're going to want to start to involve their children and their children in a capacity as either trustees or executors. So the question is, how do we get everyone on the same page? How do we introduce the right people to the planning at the right time? And how do we make sure they know what to do and that they've got the competence at continuing with planning even when the senior generation has either died or has lost mental capacity? And simply put, the best way to do that is to have a regular meeting, either as a family or with your advisor, or ideally, of course, both. Well, it might not work, is the short answer. I think a lot of the time people come up with things where either they hear something from an unregulated source, where effectively they're being misled into thinking something which is aggressive tax avoidance or tax planning will work when it won't. The issue with these things is we find out at the point of your death whether or not the planning is successful. So if you think about the mechanics of a death, what happens is the will comes out of storage, the probate solicitor is instructed, and at that point, any decisions made in the previous, however long it is, 7, 14 years, or any bequests that have been made in the will, then get collected along with all the financial information, and hopefully a really competent probate solicitor is involved and can help deal with the minefield of submitting all the various different tax returns and claiming all the various different exemptions that the planning you put in place was designed to achieve. If at that point any decisions that you've made have failed, you are never going to know. So you might, spend the rest of your life in blissful ignorance thinking that someone who sold you an aggressive tax avoidance scheme is going to have fixed all your problems, but ultimately they are likely to get off with having done that because what they told you in a meeting that might not have been recorded, what they told you in advice that might not have been provided in writing, isn't necessarily backed up by proper implementation of planning. So where we tend to work is, having a textbook approach to using all the various different tried and tested strategies, when it comes to, textbook advice, whether that is estate planning or financial planning, there is so much opportunity to do really, really good work and make a really big difference that doing anything esoteric or anything high risk or, anything that would incur the wrath of HMRC or need registering under the disclosure of tax avoidance schemes, we would just not want to, we wouldn't feel the need to go near any planning of that nature. Something that is written down, something that has been devised in an open conversation between the whole family, so at least the senior generation, the husband and wife, something that at the right time has been introduced to the children, so that they understand what to do at the time something bad happens, which is either the loss of capacity of a parent or the death of a parent. So when we have a nice, simple set of recommendations, usually in bullet point format, with all the gory detail backing up the rest of the reports, and ultimately something, if you can pick up an advice report 10 years later and understand what we're doing, why we're doing it, how the benefits are going to be achieved, and what to do at the prevailing time, that's what we would call a robust inheritance tax or estate planning strategy. When it comes to estate planning, when legislation changes or family circumstances change, it is worthwhile having a quick chat with your advisor. When we say review a plan, we don't necessarily mean that the plan needs to be completely rethought from the beginning, but you should know the person that's going to be helping your family with these things well enough that you can pick the phone up, have a quick chat, maybe annually, and just understand whether or not there's anything that needs tweaking or adding to, or any further work that needs to be done. When it comes to most financial advisors will insist on seeing their clients at least once a year, not just to review the estate side of things, but to review your wealth, your tax situation, your spending, again, changes to legislation. So, where most financial advisors will say annually at least, but ideally stay in closer contact with estate planning, it tends to be more of a case of pick up the phone and have a chat once a year without needing to necessarily have some sort of formal arrangement and a full-blown 2-hour meeting, unless there's a need for something like that.